All right, hello everyone. Welcome to our October Mortgage Quality and Compliance Committee webinar. We appreciate you tuning in and joining us this morning. My name is Samantha Gallagher. I'm the Member Engagement Director here at the California MBA. And if you have not joined us previously, we hold these webinars on a monthly basis and we cover a wide variety of compliance and quality assurance topics for the residential lending industry. This is actually our last webinar for our membership year. We'll be starting back up again in January. But if you are a member of the California MBA and you would like to be involved in our committee and help us decide on the topics and speakers and all that good stuff, please feel free to reach out to me and we can get you plugged in. And now I'm going to turn it over to our chair of our MQAC committee, Mike Steer, to introduce our wonderful presenters and the webinar we have prepared for you. Mike, take it away.
Thank you. Thank you so much, Sam. So welcome to this month's MQAC webinar. My name is Mike Steer, president of MQMR and currently serving as the MQAC chair this year, along with our vice chair, Melissa Copel, who is managing partner regulatory affairs at Loan Depot. As Sam said, we've had a full year of amazing educational webinars, and today is our last one in our 2023 series. It's been an absolute honor to serve as MQAC chair this year, and we do appreciate all the feedback you've shared to make these webinars and our topics even better. Very soon, I'll be turning this position over to Melissa, who is my MQAC partner in crime, as she becomes the chair for 2024. Just a couple quick reminders. Number one, save the date for December 11th to 12th, where we'll see you in Irvine, California at our Legal Issues and Regulatory Compliance Conference. Again, we've got a lineup of speakers that are powerful and industry thought leaders. Registration is open, so get registered and come learn about the latest hot topics and mortgage compliance and legal issues. And then lastly, on that note, we're down to our last few spots for conference sponsorships. If you're looking to get your company's name in front of your audience, don't wait. Check out the CMBA website for sponsorship details, or feel free to reach out to anyone on our team. Again, we're really excited to have such a powerful set of industry-leading speakers lined up for you at the conference. Now, a little bit about our speakers today. So first off, we've got Michael Flynn, who is a leading nationally recognized bank regulatory and mortgage and consumer lending compliance counsel. And as a former acting general counsel of HUD and former general counsel of Flagstar Bank and PNC Mortgage, he counsels financial institutions on bank, mortgage, and consumer finance regulations, regulator inquiries and examinations, product development, compliance and risk management, secondary market transactions, servicing, fintech arrangements, vendor management, and contracts, and other subjects. Today's topic is about titles. Mike happens to have quite a few titles, who is a member of Buckhalter's Commercial Finance Practice Group, co-chair of its Consumer Financial Services and Mortgage Regulatory Industry Group, and its Financial Services Regulatory Industry Group. He's also the chair of the American College of Mortgage Attorneys Residential and Regulatory Committee, and serves on the Colorado Mortgage Lenders Association Legislative and Regulatory Affairs Committee, the California MBA Legislative Review Committee, and the governing committee of the Conference on Consumer Finance Law. But not to stop there with titles, he is also a past chair of the California Lawyers Association Financial Institutions Committee, the California MBA Legal Affairs Committee, and the American Bar Association Title Insurance Litigation Committee. He is a fellow of the American College of Consumer Financial Services Lawyers, the American College of Real Estate Lawyers, and the American College of Mortgage Attorneys. Michael, thank you so much for joining us today. And last but not least, we have our second speaker, Tracy McShane, who is a senior paralegal at AmeriHome Mortgage Company, where she currently focuses on litigation management, title curative review, corporate compliance, MLO licensing, annual reports, regulatory inquiries, and state examinations. She has more than 25 years experience in managing financial services litigation and the mortgage lending and servicing arena. And prior to AmeriHome, she worked for Carrington Mortgage as the Director of Legal Services, New Century Mortgage Corporation as a Senior Paralegal, and Option One Mortgage Corporation. Now, her main focus has been supporting servicing teams and defending servicing-related litigation, escalated bankruptcy matters, and managing title curative issues in the default world. She's also well-versed in managing class action litigation, as well as insurance defense and coverage analysis. Quite the titles for both of our speakers today. Now, with that, we're both happy to have you on today as our industry leaders, as we're about to learn the ins and outs of the title world. And I will go ahead and turn it over. Michael Flynn, Tracy McShane, ladies and gentlemen, go ahead and take it. Thank you.
Thank you, Michael, and thank you for that warm introduction and going on for far too long. And on behalf of both of us, thanks to the CMBA and to the committee for asking us to speak. We're very pleased to be doing so and hope we can add some value here. I'm really excited about working with Tracy. We prepped for this last week, and it's very clear she has years of excellent experience in handling the practical aspects of title insurance as it relates to mortgage lenders, including an important issue of claims tendering, responding to claims disputes, and that sort of thing. So I'm really looking forward to her interjections today with her thoughts on this from a practical perspective. What we're going to do today is do a little bit of basics of what is title insurance, and then to get into more practical things as opposed to theoretical. We're going to talk about the different stages of getting title insurance in the underwriting stage, working with title companies and closers and agents and how you should think about that, then what the title policy actually insures and does for you. Then we're going to spend quite a bit of time on claims handling and practical tips for what you do when you're handling claims. So why don't we dive right in and go to the first subsequent slide. Next slide, please. Okay, you can keep going. This is just my firm's bragging sheets. You don't need to read that. Okay, what is title insurance? Something to keep in mind that I think some people who work for lenders don't necessarily think about very much is title insurance is not a guarantee of what title is. If you have a title insurance policy, you don't have a guarantee or certainty that the title is the title to the property that you're secured by is what you think it is, or that your loan has its priority or recording title that you thought it had. What title insurance is, it's an indemnity contract, like most insurance policies. It's a money contract, and as such, it pays out when certain events happen that are set out, and it pays the amounts called for. And so, essentially, if you have an insured covered loss of title event, it will pay you certain amounts for that. They may choose to fix your title because it's easier for them or cheaper, but they don't necessarily have to. We'll get into all that. There are some other options you can consider, which the main one being attorney opinion letters. And I have some thoughts, but Tracy, I was wondering, what do you think about attorney opinion letters and their use in lieu of title insurance?
Michael, I'm not very familiar with the attorney opinion letters because I've not seen them, in the collateral files of the loans I've ever serviced. And I think there's very specific guidelines in which a lender would accept an attorney opinion letter. Am I correct?
I think that's right. And I think the main difference is, and although I know that some of the GSEs allow them, or at least under certain circumstances, my understanding, just like you, is that almost no one's using them. And the reason is, I think, is because a title insurance policy, they're obligated to respond to you, pay you certain amounts. That's the essence of the contract, and that's what they do all day. It's their business. If you have an attorney opinion letter and you claim that the attorney made a mistake on title, on his title search, his or her title search, and you make a claim for recovery, you're likely to get into a drag out dispute with that attorney, possibly even have to file a lawsuit. So your recovery is much more tentative and it takes much longer. So most lenders simply stay away from it, partly because they don't get the kind of service that title companies provide when they oftentimes come in and fix things for you at the very beginning or litigate for you and things like that to clear your title. So I don't think there's a lot of use of that kind of product, but I think a lot of people took a lot of time looking at it a couple of years ago and became hot. I think most people concluded they didn't want to use it. So it's not often seen. So let's go to the next slide. As we said, title insurance provides for payments, but what it provides for payments for are generally things that are what's called of record, things that are that were in the county recording office of record against the property as of the date you got the policy, i.e. the date you made your loan. It covers title defects and liens, but if they're excluded or exempt from the policy, they're not covered. The kind of things that are covered are things like prior mortgages that weren't paid off and released. They're of record in the county office. You get your title policy as of that date, and they're already there. They haven't been cleared out. So if they haven't been accepted out, if they were missed, they're going to be covered. Prior tax liens, prior grants by the borrower of a full or partial property title to a third party. Those kind of things may well be covered if they weren't accepted out in the preliminary report, which we'll also talk about. So let's talk about the transactions. Next slide, please. Title insurance is obtained in the closing process through a title agent. Title agents issue title policies. They do the actual underwriting. If you think of First American, Fidelity, Old Republic, they're not usually doing the underwriting. The local title company, the title agent you employ, does the actual underwriting, does the inspection, and issues the policy. They issue it on behalf of, in the name of, one of the big national underwriters, but it's local policy you're actually dealing with. All the big companies use agents. There are different kinds of agents. There's what's called captive agencies, which are owned by or affiliated with underwriters. It might be a local Fidelity national title shop, might be a local Chicago title shop, a Commonwealth shop, a First American shop. Those are affiliated or underwriter owned agencies. Independent agents also exist. They are not owned by the title companies. They may be affiliated with only one underwriter. You often see that. Much like some insurance agents that you see will only give you State Farm insurance policies, but they're not State Farm owned agents. But other insurance agents you go to may say, well, we can do stuff through State Farm, through Allstate, we can find you the best policy. Title insurance agents can be organized the same way, for one underwriter or as an agent for several underwriters. One of the things to be aware of is what we're talking about is title agents. Title agents are limited agents. They get their agency from what's called actual authority, which is when the title insurer contracts with them to make them an agent for the underwriting and issuance of a title policy. They have what we call in the law ostensible authority, which is what you may want to keep an eye out for as a lender if you're ever going to make a claim against them. Does the title insurer treat them in a way or provide them with documents or other materials that would cause you in your position to believe that they are an agent because they sort of appear to be an agent of the title company? And we'll get to more.
And Michael, I think you find that a lot in like the state of New York. I've had a lot of problems where the title companies come back and said, well, it wasn't our agent, it was an agent of the lender.
Yeah.
When the attorney ran off with, the closing funds. And I found that, if the firm is still intact, one good thing would be to file a claim under the attorney's E&O coverage as well.
Absolutely. Absolutely. It's interesting. I have a matter right now involving that kind of problem in New York. And New York's a state that by law, by rule of the financial regulators there, title insurers cannot issue closing protection letters for the title agents. So the title agents are, as you said, are pretty independent, and you have to find ways to go after them directly. And we'll talk about some of that in a minute. We'll talk about how to react to underwriter claims that the closer is not its agent. There's some things you can do. You can look again to what did the insurer give the agent that would lead you to believe that the agent was acting in their behalf or should be acting in their behalf or was authorized to act in their behalf. Those are the kind of things you'll want to look at if you have to make a claim against the agent. So let's go on and talk a little bit more about title agents. Next page. Keep in mind that depending on what state you're in, even what county you're in, the title agents may also be the closers or the escrow agents. That's not uncommon. But if they're not the closer or the escrow agent, the closer will order title insurance from the title agent who delivers the policy to the closer agent who then delivers it to you. But it's not the closer that's the title agent, it's the title agent they do business with. If the title agent is also the closer or the escrow, it does both. It handles the closing and it underwrites and issues the title policy. In some places, attorneys act as closers and title agents. New York, for instance, has that kind of system where attorneys often do the closings and oftentimes issue the title policies. The thing you need to be careful of is who, as Tracy said, is who they're claiming to represent. Who are they actually representing? What do they say in their agreements with you as to who they represent? Because if they're acting as an attorney in the transaction as well, you've got some potential conflict issues where they might be representing the seller, but they're doing the closing, and you don't necessarily want to get caught up in the kind of problems that arise from that. So you need to keep an eye on that when you get your letter or agreement from the closing agent who's also acting as an attorney. Let's go to the next page.
Michael, I believe that, on the origination side, these the title underwriters have a list of preferred or like excluded and approved closing agents, escrow officers. So on the origination side, it's very important that they're looking at that list to make sure they're not using somebody that is no longer on the approved list for the underwriter.
That's a good point. And you as a lender can reach out to the underwriter and get confirmation of that. In the underwriting stage, to confirm that the agent you're using is an approved agent or is not an approved agent. Obviously, if they were approved and have been de-approved, that's probably somebody you want to stay away from for obvious reasons. So, but in regard to that, when you're doing a purchase transaction, it's usually not the lender's decision who the closer is going to be. That's usually up to the buyer or seller, depending upon local practice. And but it is going to be the lender's decision oftentimes on refis, particularly on lender-to-lender refis. And there you have an opportunity to, first of all, to pick and try to get the closer you want, usually the local branch of it owned by a title insurance company. You get more protections that way. And you get to negotiate better discount bulk rates on big transactions, like when you have lender-to-lender refis. They will oftentimes give you better scopes of coverage and better fee charges if you're sending all your business to them that way. Now, you can't do it as a RESPA violation, but if you do it legitimately, they do offer those kind of pricings, largely because if they're doing a bulk refi thing, they can justify lower costs because they have more efficiencies built in. One thing to point out, as Tracy said, the lender doesn't necessarily pick the closer, and the title companies have or title insurers have their list of unapproved agents. But even if you don't find that somebody's not approved, as a lender, you can put your foot down and say, we don't use that. We will not do a deal with that closer. You can maintain your own list of people you've had problems with that you don't want to use. Now, of course, it's possible that the buyer there may say, well, then I don't want to use you, lender, because we're already committed to using this closer. But I think a lot of the times, I don't know about you, Tracy, when I've seen this, they just change closers. When a lender doesn't use a closer, they'll just change the closer. And that's something to keep in mind. If you really have a problem with an agent, you shouldn't be doing business with them, and you should take these steps. If you has a choice of the agents, closing agents, title agents, either one, if you have a choice because it's a refi or because in the purchase transaction, the way the transaction is shaped up, you have some say in it, I'd recommend you think about things like use an agent, a title agent, who's also the closer. Keep that together so there's one person to focus on. Don't let them hide and point fingers at each other in the dispute you're having with them later. Use an agent owned by a title underwriter. If you can't get that, the best thing is to get an independent agent who's an exclusive agent for one underwriter. You want the underwriter pulled in a legitimate relationship with that closing agent and title agent as much as you can. And of course, always get a closing protection letter. We're going to talk about those in a minute. They're not perfect, they're not great, but they do give you some contractual rights. Let's go on to the next page and start discussing closing protection letters. And I should say here that if we get into these, as we get into these form documents, if you email either me or Tracy, we can get to you the form documents we're referring to here. They're all, we're talking largely about ALTA forms. The California forms are similar, but they're all pretty standard. So we didn't include them here. That'd be way too much material. We just summarized them. But if you want to see them and aren't familiar with them, feel free to reach out to us. So closing protection letters are from title underwriters. They promise to pay the lender for certain types of losses caused by the title agent or closing agent in conducting closing or issuing a title policy, but only if certain conditions are met. That's like with everything title insurers do. Conditions have to be met for them to have any responsibility. they issue CPLs to encourage lenders to use their agents and buy their policies. And they're very happy to give them out to you if you want them. Close protection letters can be for a single transaction or maybe blanket to cover all transactions of a particular type by an agent. A lot of lenders get blanket closing protection letters saying if you do business, Fidelity National Title says that if you use agent ABC of ours for any closings that you're making in the following states of less than $500,000, less than $1 million, whatever they put in there, we give you the following protections, and they list out the closing protection letter protections. The
only sad thing is the closing protection letter is only good for 1 year. You can only make a claim. And that's why it's so important when like the post-close or the audit group gets that final policy, if they notice an exception that's in there that shouldn't be, to get that to somebody that can file a claim or request that policy be amended to remove that exception right off the bat, as opposed to when the loan goes into default and there's no coverage under that closing protection letter because it's 2 to 3 years down the line.
Yeah, Tracy's absolutely right about timing. You'll see, we talked about it several times in here. When you spot a problem or you spot facts you think might be creating a problem related to your title, notify the closer, notify the title insurer immediately, even if it hasn't matured into anything. Get them on notice. They will claim otherwise later that your failure to put them on notice somehow hurt them or prejudice them. And the point about getting it done within a year or whatever the time limits are, Tracy's absolutely right. They are sticklers for that. It's a way out of the obligation for them if you don't do it timely. And there are reasons why they stand by that besides saving money. Facts get sticky.
Michael, can you think of something that would be covered under the closing protection letter but's not covered under the policy?
Loss of funds related to title might be covered. I mean, even if they're able to, I suppose if the loss of funds resulted in title not being established properly, the title policy would cover it too. But the title policy would only cover what's needed to get what's needed to get the title straightened out, or what's needed, the amount of money you lost because your title wasn't correct. It doesn't cover the money that you put into the transaction that the agent absconded with. That's usually going to be the same amount, I would think, but it doesn't have to be theoretically. So they are slightly different that way. But you're right, most of the time it's going to be covered by the policy as well. The closing protection letter helps though, particularly when an agent doesn't issue a policy. Just as a practical matter, they'll respond more quickly, I think, to a document, a contract that exists on paper, a closing protection letter, as opposed to taking your commitment and trying to say, you committed to this, now give us the policy you asked for, and now we have a claim under the policy. That's a much more convoluted effort to protect yourself. So the closing protection, I think, sort of helps that way.
But if a policy was never issued, I've filed claims under the commitment all the time. For just because they failed to issue a policy doesn't mean there's no coverage, as long as you can prove that you paid for that policy.
Absolutely. It's just that I think it tends to, anything that makes it easier for you to process your claims, I think is a good thing. And closing protection letters are free, and they make it easier to make a claim. And if you're doing what you do, which is tendering on a commitment letter, I've seen circumstances, not often, but sometimes where lenders sort of jump through hoops, and then insurers jump through hoops. They then take the commitment letter, you go back and forth in letters clarifying exactly what the commitment letter was covering. It gets a little more difficult. So I always recommend the closing protection letters. We talked about, like a title policy, the closing protection letter is limited. It's very specific. It covers losses related to the agent's failure to follow you, the lender's written instructions related to either, number one, a disbursement of funds that affects the status of title or the validity and enforceability of the mortgage. So it's got to be a failure to follow your instructions, your escrow closing instructions, that somehow causes there to be a defect in the title or a failure to record title or something like that. Or two, the obtaining of any document specifically required by the lender only to the extent that the failure to obtain the document, again, affects the status of title or the validity. So if you instruct them to get a certain document, a release, something like that, they don't get it, closing protection letter steps in immediately on that. And then directly money losses, it covers fraud, theft, dishonesty, or misappropriation by the issuing agent or the approved attorney in handling your funds or documents, if it affects the status of title. That's a bit of a limitation because, you know, you do see, particularly in bad economic times, agents abscond with closing funds. They will oftentimes gather up all the funds over a few days, and that can be quite a large sum of money from several lenders, and they disappear to Mexico. That does happen more frequently than you might think. And in that case, there used to be a lot of fighting between title insurers and lenders about, was the title insurer liable? Did the closing protection letter cover it? They tightened down the closing protection letter, and now it covers that kind of loss of funds only if they're stealing your funds results in, as Tracy was saying, you don't get a title policy, your deed doesn't get recorded, things that actually affect your title. They're responsible for those funds that lead to that under this provision of the closing protection letter. But it's limited, so you have to really pay attention to what you're saying. Let's go to the next slide. As Tracy was, next slide, thank you. As Tracy was indicating earlier, it doesn't provide general protection for anything an agent does. And that's why her point about New York is problematic. Even if you had a closing protection letter there, you wouldn't have complete coverage. But you have to look to the agent for a lot of the problems you have if they aren't covered by the closing protection letter. Fortunately, a lot of the bigger problems do affect your title, do affect your the perfection of your security lien, so that you get at least that much coverage, but from the closing protection letter. But they are not complete protections. Let's talk a little bit more about closing protection letters. Next slide, please. So we talked about that. Next slide, please. So we already spoke about this. There are some other limitations on the applicability of a closing protection letter. As Tracy said, it's got to be submitted within 1 year of your transmittal of funds in the closing, which shows you if a deal doesn't close for a long time, borrower comes in and then they put off getting their loan for a long time for whatever reasons they have, you've got to get a new closing protection letter. You probably have to start a whole new loan process, but you definitely have to get a new closing protection letter. And here's what's not covered, that you might think is. Your closing instructions requiring different title insurance coverage than is set forth in the commitment. So if you change what title insurance coverage you want after the commitment, you got to sort of start all over. The closing protection letter won't help you. And loss of funds due to bank insolvency, failure, or suspension. If your agent is very sloppy and drops your money into a bank that fails, even if they knew it should have failed, you don't have a closing protection letter claim. You've probably got a negligence claim or breach of contract claim against your closer, but you don't have a closing protection letter claim. Let's go on. Next slide, please. I've listed a few more. I'm not going to go into them. The only one I'm going to point out is the third bullet point: matters created, suffered, assumed, agreed to, or known by the lender. So if it's something that you caused, something that you knew about and should have fixed, that type of thing, they don't cover that. You'll see that in title policies too. You can't stick them with a problem you knew about or a problem you should have known about. Can you
give us an example of a matter that a lender would have known about?
If the lender knew that the borrower didn't really have title, if the lender knew, this is more of a title policy issue, but if the lender knew that the borrower had deeded half their title to their cousin a year earlier, and that didn't show up on the,
I've
On the
seen
exception.
I've seen loans made with a life estate interest, which is like a huge,
Yeah.
red flag, because you can't foreclose until the person with the life estate, dies. So that, would that be considered like a complete failure of title, or, that's, to me, seems like an unfixable.
Yeah, what's the scenario again? I'm sorry.
Like if we made a loan and to John Doe, but he also gave his mother a life estate interest, so she could live there for the remainder of her life.
Yeah, if that wasn't picked up and in any of these documents we're talking about and it's shown in the exceptions,
Mhm.
you have a claim to the extent that actually affects your title or your ability to recover on your title when you get to a foreclosure. Obviously, if you go to foreclosure and there's a life estate sitting out there, you're going to recover a lot less. So there's a loss, and that is covered. Another example you see sometimes that where this created suffer assume comes in is mechanics liens, where the lender had looked at the property and or their appraiser looked at the property and should have seen that the ground had broken on the construction. That's an example of created suffered or assumed. So, well, let's go on to the next page. So let's talk more generally. When the closing protection letter doesn't exist in New York, for instance, or you're using an agent that is not an agent of an underwriter, or the closing protection letter just doesn't quite fit. First thing you want to do is look and see, can I make a claim under the closing protection letter to get a recovery against the title agent or the closer, again, against the underwriter for their actions. But if there's not a closing protection letter for any reason, or it doesn't apply, you have to look at the closer's obligations. They may have contractual breach of your escrow instructions if you have good escrow instructions. They may have a breach of legal fiduciary duties because they are acting as a fiduciary of yours in a limited capacity as an escrow essentially, or they may breach the terms of the commitment. And that these may create claims against the underwriter on the commitment and if there's a CPL, but there's also a need to go after the title agent and closer themselves. You'd want to make claims against the title agent and closer. At the same time, make claims against the title company for contractual breach of escrow instructions, breach of fiduciary duty. And we'll talk about some of the escrow instructions you want to have in a minute or two. What if they fail to perform or abscond with the funds, or as Tracy pointed out, won't issue the title policy? She said, don't wait. Tell them right away, put them on notice right away, even if it's not technically yet matured into a claim or a demand. Let them know the facts are out there that are going to mature. Otherwise, they will claim you prejudiced them by not giving you an opportunity to fix it for you. And as Tracy said, because the commitment creates an obligation for the underwriter to issue a policy, if they don't issue a policy, you can ask the underwriter to act as if the commitment is a policy and make your claims under that if necessary, or ask them or say, nothing's happened yet, but we haven't gotten a policy. You committed to give us a policy. Give us a policy. The agent's gone to Mexico. His files are missing. Give us a policy. And they have to do that.
Michael, what if you make a claim and, instead of fixing the issue, they just give you a letter of indemnity? Is that acceptable?
A letter of indemnity is actually not acceptable as a cure. Everybody does it. But if you look at the language, what they're promised to do, they promise to, like in the title policy, it'll say they have some choices. They can litigate to clear title if they do it in a reasonable time. They can defend you against a title claim if it's a reasonable amount of time. They can pay you policy, the lesser of policy limits, or the loss you suffered, or the amount of your loan, or they can buy the loan from you. They could do all those things, but I'm sorry. What's the prelude to what I was just talking about? I apologize.
I was saying, is a letter of indemnity acceptable when you, like, say, someone comes and say, well, I had a judgment against this borrower and they refinanced and it was record, but it wasn't paid off at closing.
Right.
So I'll file a claim just to put the title company on notice, but they basically give us a letter of indemnity saying, well, you haven't suffered a loss because this person hasn't come forward and tried to foreclose on that judgment. So you've not suffered any loss until, you know, X, Y, and Z happens.
Right, and that's actually interesting. It doesn't relate to the question of the indemnity letter. That they give you that to sort of both help you and maintain the relationship. They're right that the policy says until you have a claim against your title, you know, finding a defect in title by itself doesn't necessarily give rise to a title claim. There has to be some event that causes your title to be jeopardized by that rogue title, or you go to foreclose and you suffer a loss because you got this, or someone makes a claim against you. And make a claim against you, that's a clear claim against title. They then have to defend you or pay you off or something, the title company does. But the indemnity letter is not a provision under the title policy or closing protection letter as a cure. People do it all the time, but it's sort of a, you know, informal way of addressing it. It doesn't fulfill their obligations to you at all. And you should always, if they send one to you, I wouldn't throw it away. It might come in handy, but I would write them back and say, thank you for this, but you still have all your obligations under the policy. You haven't met any of the, you know, any of your obligations in the policy. None have been met. Now they will come back and say, you don't have an event of loss yet. You can fight about that if that's an issue at this point. But the indemnity letter, it's really most often used where I see it is to get through a closing when people see a problem, but it doesn't fix the problem. You still have to have them insure against the problem. So if you spot, for instance, a prior deed, a prior loan and deed of trust that haven't been reconveyed when you get to closing and they haven't been accepted out, they show up. And then you want to get to closing and nobody can find the party to get the release, and you're not in the state that allows the title company to do a release. They're not going to want to go to the trouble of doing a declaratory relief legal action. So they give you the indemnity letter and you'll close, but you need to make sure, in spite of that indemnity letter, that your title policy that they give you doesn't exclude that thing that they missed, and that they're still on the hook under the title policy for it, because the indemnity letter is a separate agreement and may not be as thorough, may not cover as much, and you'd have to sue them under the indemnity letter, and that's just not where you want to be. So let's we go to the next slide. So we're going to talk now about the commitments and the title policies. They're very similar. The commitment or preliminary report is what they send you, what the agent sends you when you as the lender contact them, or the closing agent contacts them to tell you what is going to be in the final title policy. You get to review it, ask them to adjust it. It essentially includes certain general exceptions and exclusions, some of which are standard. They'll say things like, any in this neighborhood, any restrictive racial covenants are excluded. They always are, as they should be. And also specific things like, there is a prior loan here that's going to get paid off in your closing. That's excluded from coverage. It's the policy also separately listed as something that needs to be fixed before, or the commitment says that's got to be cleaned up before policy is issued, so you're protected. But those kind of things are all listed in the policies and title commitments, and work the same way. You end up with a title policy that should ensure your record exactly as it exists. If it doesn't, you have a claim, but it should give you some level of certainty that you're closing in the way you think your title is supposed to close. And that's the whole purpose of this arrangement. So there are long forms and short forms of these documents. The long forms set out all the conditions, exceptions, the contract provisions about how things work, typical assurance provisions, and they are applied. They lay them all out in detail as a long form. The short form is similar, except it only has the information and exceptions specific to the particular property and transaction. The amount of your loan, date of your loan, the deed of trust, who's on title to the property now, the amount of the transaction, and any specific exclusions like the type we just discussed about this particular transaction. The general stuff is in the long form, and the short form references the long form by reference. It incorporates it that way, and therefore you don't need to have 15-page title documents in every single loan file record you keep. You can have a 2 or 3 page short form and a master long form. And for sometimes master long forms might even be recorded in the county recorder's office and you refer to them that way. But generally they will send you the long form. You then keep that and add and your short forms applied to it. But it's a much simpler record keeping process for lenders, particularly working at volume, and particularly for your underwriters looking at a new loan they want to look at. They don't want to get lost in 14 pages of insurance stuff and long-term exceptions that don't really matter here. They want to see what's relevant for this particular loan so they can decide what they want to push back on. So
Is there any benefit to getting a long form versus a short form, or does it give you the same coverage?
it should give you the same coverage because your short form should have a paragraph towards the beginning that says it is referencing that company's long form. And that gives you the complete coverage then. You just want to make sure it's the right short form and long form. Like if you're getting expanded coverage, you want to make sure it's the short form expanded and the long form expanded. Otherwise you got a little bit of confusion there. But you'll generally, as a lender, if you're always getting expanded coverage, you'll just be routinely asking for expanded coverage short form. If you're always getting regular coverage, you'll be asking for that. So it sort of sorts itself out in your processes.
One thing I've noticed is the short form never, it normally lists as the date, it doesn't follow up on the recording of the mortgage. So you'll have the date of closing or the date the mortgage is recorded, whichever is later. And so, a lot of times when you get that short form, you don't have confirmation that the mortgage is in fact, recorded.
Right, that you have to follow up with separately in post-closing. And they should notify you, when that happens, obviously. And the county recorder, if it's recorded in your name and your address, it's on the return address, you should get notice from them and a copy of the recording as well. You just have to go back but that requires you to go back and check, after the fact at some point to see if you have them all. Well, let's talk a little bit more about the commitments, the preliminary title report / commitment. What it is, let's go on to the next slide. As we said, it's a written statement by the title agent on behalf of the underwriter as under what conditions issue the policy, what it covers, what's excluded, and that sort of thing. Long form commitment, it's very similar. It just doesn't go into the specifics. Or it does go into the specifics of this transaction if you get a specific long form for this individual transaction. Let's go to the next page. And as we said, the short form lays out everything for the specific transaction. The format, similar to a title policy, is you have Schedule A, which sets out the general insurance information, the name of the insured, the policy amount, things like that. The title of the property, or the property description. Schedule B, Part 1, is the same type of requirements as the long form, requirements they need to close and that sort of thing. Part 2 lists the specific exceptions, specific matters. As we talked about, one is going to be the loan you're replacing. That's going to be listed as an exception. And anything else they find that might be there that has to be addressed. Prior mortgages, tax liens, things like that come up. Now you're going to want all those fixed. Let's go to the next slide. So what you will do is they will write into the commitment that the conditions to close include fixing those exceptions that should be fixed. And if your underwriter sees they aren't dealing with it, you need to push back during your underwriting and make them commit to fixing that before they issue the policy. So the next thing you can get along with the policy and the commitments is endorsements. We're not going to go through them all. There are a million endorsements, and they cover all sorts of things. Things like condominium and PUD assessment priorities, variable rate mortgages, environmental protection liens, CC&Rs, restrictions, encroachments, all sorts of things that, let's go to the next slide while we're talking about this.
Michael, I've seen one other endorsement I think is very important, and I'm not sure what they call it in California. I think it's the California 116, and that basically says that, the legal description that you're insuring contains a 1 to 4 family dwelling, because I've had several loans on, you know, where our legal description covered the vacant lot next door. So if you have that 116 endorsement, it basically says there is a house
Yeah.
on the legal description that we're covering, which is very helpful when you're trying to make a claim.
Right. And I'm sure, Tracy, I'm sure your company does this. Most lenders do this, but it's important when you're doing the kind of volume underwriting that comes in residential, that you have your own list and schedules of what endorsements you want, and then any add-ons you want for that particular transaction. And that should be incorporated as a standard part of your closing instructions. So it always gets plugged into your closing, to the instructions to get the endorsements you want. Now let's go to the escrow instructions. This is the part we really want to emphasize, because this sets up everyone for if there's a problem. I'm not going to go through all these, but I've listed out a large number of provisions that we always recommend go into your escrow instructions. You've got to be complete, because if something's not in the escrow instructions the way you want it, I can assure you the escrow instructions you're starting from that the escrow agent gives you won't have in there necessarily what you want. So you need to make sure all these things get included. A lot of them have to do with the escrow agent has to ensure that your loan's going to be in first position. They won't disperse funds without a matching title policy that matches the commitment. And then more specific things that tend to produce a lot of problems, such as the closing will occur in the closer's shop and cannot be taken out of the closer's shop without you, the lender's written permission, that no one may close except the closer without your written permission. I once had a case where a company I worked where I was in-house, where the closer on many transactions was letting this one broker take out hundreds of loans and close them himself at people's houses. And it resulted in claims from all these hundreds of borrowers that they had never gotten the TILA rescission notice. And the total cost of that problem was about $3.5 million, paid for by the closing agency ultimately. But it was a very big problem, and we had to fight them for a long time to get that payment. So some of these are very general, some of these are very specific to deal with things like this. And notice, second to last bullet point, Tracy, I mentioned that insure over letters don't suffice. You want to say that in your closing instructions. You'll take them as an extra protection, but they don't suffice to cover the problem you want fixed or not insured over, that you want to be covered under the policy. So I recommend everybody pay close attention to this list. You should consider whether you have these things in your escrow instructions, and if not, think about putting them in. I've had many claims that got resolved well for the lender because they have very good closing instructions. As an example, the one I just gave you about not taking closings out of the shop, it only worked because, this is quite a while ago, our in-house upfront person who wrote our escrow instructions had enough sense to put into the escrow instructions, standard escrow instructions, the closings could not be taken out of the closer's shop and could not be done by anyone but the closer without our express written permission. And that was the basis upon which we got them to pay the $3.5 million. So these things are actually pretty important. Let's go on to the title.
About notary? What about the notary fraud? You know, where does that fall?
Well, it depends. I mean, if the notary is an employee of the escrow, that's a good thing, right? I mean, that protects you more. In fact, if you can get that, if you can put that into your escrow instructions, that probably helps. Problem is, if they aren't, you have claims against the notary's bond, which could be difficult to work through. And you probably have claims against the closer if they negligently selected the notary or didn't supervise them properly. That's a really hard thing to prove, obviously. So I think the best thing to do, if you can, is use a notary employed by the closing agent or by the title insurer, preferably the title insurer, you know, or their totally owned subsidiary closing company. That's probably the best protection. So let's go on to the title policy. We're running out of time, so I'm not really going to say anything about title policy. I think what we said about the commitment pretty well tells you what's in the title policy and how to think about it. Glad to take any other questions, you know, after the fact or some other time if you want to reach out to either Tracy or me. But we really want to spend a little time on claims handling. Let's move a few slides up to claims handling. So the title policy spells out the insurer's rights and obligations and claims. As Tracy says, you must notify them when you learn of any matter that could create coverage under the claim. Notify them quickly. You should always provide notice when it's discovered, because even if no claims arisen yet, they'll claim your failure to tell them caused them to not jump on it quickly enough and fix the problem in a way where it could have been fixed easily. Do it in writing. They have the right to ask for a written proof of loss where you try to quantify your expected loss from your claim. You have to give it to them. You have to do what their policy says you have to do, or you can waive your coverage. Most states, they have to respond within about 30 days. They can accept the claim, accept it with a reservation of rights, or deny the claim. If they accept with the reservation of rights, that means, yes, we'll defend you in this matter, or we'll start to try to fix it, but we're going to ask you for more documents to investigate if there was something in here that would alleviate coverage, like you caused the problem. That's a very common one. You'll see them sometimes ask for entire loan files because they think you ignored a problem. You should always push back on that. They usually don't have any reason to be asking for the whole loan file. Usually the quality of your underwriting is not related to title. Your underwriting is a credit issue, credit insurance issue. It's not a title insurance issue. So unless they have specific reasons to want all those documents, you should push back on that stuff. Or even better yet, hire an outside lawyer who knows how to push back and push back really hard. Next slide. They have to defend you in litigation if there's a claim against your title. They can select counsel subject to your reasonable objection. If they select somebody who's just not experienced in this area, not recognized in the community, you can say no. You should also watch out for them wanting to use one of their pool of in-house litigators to handle your claim. If that person's experienced, you can't say much about it, but you can push back if it's some new person they recently hired. You can also look for conflict situations. If there is if the title insurer is pushing back against you on the basis that you committed fraud in the transaction or did something wrong, they should not be using an in-house lawyer to represent you, because an in-house lawyer is an employee of theirs, and you and they are in a conflict situation already. And under legal rules, legal ethics rules, they shouldn't be representing you. They should get a good outside lawyer. If they use in-house lawyer to represent both you and the borrower, when a third party is making a claim, you have to look and see, are our interests aligned? I'll give you an example. I once had a case where a title insurer wanted to use the same counsel, same in-house counsel for us and the borrower, when there was this lawsuit with very sloppy pleading and just generally alleged that we had both committed some sort of fraud somewhere in the transaction. Well, we pushed back and said, you can't have us both use the same lawyer, because we're potentially adverse to the borrower, because either they committed fraud or we committed fraud. We both committed fraud. We're obviously against one another in that sense, in this allegation. They agreed then to give us two lawyers, but they gave us two lawyers from their pool of in-house litigators. We pushed back again and said no, because they're both, essentially that's one law firm. The law firm has the conflict. That was quite a struggle, but we finally made them realize that that's right. Their in-house litigators don't stand alone. They're part of the corporation, so they can't have two of them representing you when you have conflict situations. And watch out for that. It's a way actually to get to an outside lawyer who oftentimes will handle these claims more aggressively or more thoroughly. The in-house people carry a big case, and they oftentimes don't have the time to spend a lot of time on your claim at any given point. So I always prefer to push to an outside lawyer.
What I find is helpful is, say I do tender a claim that's, that requires, them retaining outside counsel. I will let them know, because they're slow to make a coverage determination, I retained our preferred counsel, and a lot of times they'll just agree to let your preferred counsel continue on with the case and then pay them separately, which is nice.
Yeah, that does help. And it gives you some comfort, and you're probably going to get somebody who may know this stuff better and know the way you handle it better, which is obviously really preferable. Let's go to the next page, which we want to point out to you, as we said earlier, the options they have besides litigating for you. They can try to settle the claim. They can pay the amount of insurance under the policy, or they can purchase your loan for the amount of indebtedness at that time. They can pay or settle with the third party who's claiming title. They can settle with you for a different amount if they want, or they can go litigate and win a lawsuit for you. All those are viable options for them, and they get to choose. Now, if they use those things to delay, you can push back separately that that's a bad faith tactic and demand they do something else. But they will try not to do that because they think they have their contractual right. Let's go to the next page. There are limitations on what they have to pay you in this indemnity contract. The amount of damages is the lesser of the amount of insurance, the amount of your present indebtedness, the difference between the fair market value of the title as it was insured versus the fair market value of the title with the defect or issue if it can't be removed. So if there's a $40,000 prior lien that didn't get removed, your loss is probably $40,000, unless it causes a total loss of your lien because of priorities. You do get some bumps up if they try to litigate and aren't successful. You get an increase in the value. That's to protect you from their delays. Let's go to the next page. Just wanted to remind you that they have state obligations about how to handle claims. They're insurers like any other insurer, and they have to follow the same rules. They must timely respond to claims tenders. They have to accept or deny claims. If they fail to accept a claim properly, that's a problem. If they fail to defend, it's a problem. If they fail to pay a claim, fail to pay you, that's a problem. Delays in making payment are illegal. And all these things constitute unfair claim settlement practices. And I've listed here some resources to look at what the various state rules are regarding what are specific unfair claim settlement practices. They're very similar in every state. They involve both timing and duties to respond honestly and accurately. Let's go to the next page. What you tend to see are wrongful denials of coverage, delays in responding to a tender, the insurer saying you must foreclose before there's a loss. Tracy, we've talked about that. That comes up a lot. And them insisting on defending litigation or initiating instead of paying you. What can you do about it? Well, we have some suggested recommendations. Let's go to the next page. Make the claim to the escrow closer as well. We've talked about that, as well as the title company. If the CPL is implicated, include that in your claims letter. Tender it quickly. And if you have a reason to think the insurer should pay to eliminate the issue immediately, spell it out and demand it. Everything you think might come up as a demand for you or something you want, put it in there right away so you can put them on notice and argue later if you have to, that they knew what you wanted, they knew what you needed, and they just didn't do it. So always include that. Follow up in writing if the insurer is slow to respond, if they take more than 30 days, or if you send them materials and they don't get back to you. If you've got a deadline to litigation and all they do is get a delay, they get an extension from the other side indefinitely to respond and they leave you hanging, you've got to push on them. Let's go to the next page. So the practical steps, other practical steps. We talk about not accepting the wrong attorney. Are they causing delays? Demand an immediate cure and spell out the harm that's being caused. And if they're acting in bad faith, in your opinion, say so in writing. The words bad faith are very important to an insurer because they open up punitive damages and they don't want you alleging that. So always push back that way. And I'd recommend you push really hard. If they are just not cooperating with what you want, push very hard. Tracy and I talked the other day about a very simple trick involving some of this, where they say that you have to, for instance, there are tax liens on the property and you're going to foreclose, and Freddie and Fannie say you can't foreclose with a tax lien on the property. Title insurer says there's no loss until you foreclose under the policy. You should be pushing back really hard on situations like that, both saying that they've effectively denied you the benefits of the policy because you can't actually foreclose, and that's a bad faith. That'd be a bad faith argument you'd have with them. But also, don't be afraid to set them off against other title insurers. They're all very, very competitive. They're fighting all the time for your business. If you're using 2 or 3 of them and one of them starts playing this kind of game consistently with you, and I had a case a while back for a very large national lender where a couple of big underwriters were taking this position on every tax lien, and this poor lender had to come out of pocket to clear every tax lien, every other minor thing on the properties they were defaulting before they could foreclose on Freddie Fannie loans. And we just said, look, tell them if they don't clean this up, you're going to go to Old Republic or First American, whoever, you're going to move your business. And miraculously, things cleaned up pretty quickly because they want your business and you have a lot of power there. The last thing we wanted to talk to you about was we came up with a list here of suggested form documents you should think about having. I know Tracy creates a lot of form closing letter or demand letters and things. These are all form letters we think you should have to make your processes go more smoothly, to be more accurate in your demands to them, to push the demands, to be able to build your processes so you know when to send the next letter and track how long they're taking. These things are all worthwhile to build out. And the most important one, I think, Tracy, I don't know your opinion, but the most important one to me is your closing and escrow instructions. They
Yes.
should be thorough as possible. And with all the key provisions we talked about, to set these things up if things go wrong. And more importantly, to give the escrow the guide to what to do right so the deal closes correctly. So, Tracy,
And one more, if you think your claim has been wrongfully denied, and sometimes it pays to hire outside counsel to take a look at it and review it, because a lot of times they did wrongfully deny it, and you may have a bad faith claim, or just an attorney getting involved may push the title insurance company to accept coverage.
right, and of course, I'm always in favor of going to outside counsel, but if you can figure out how to do it, if you can figure out how to do it in-house, that's always a good thing. So.
Beautiful. Well, we know a
Right.
great outside counsel, Michael Flynn. You know where to find him. Michael Flynn's on LinkedIn. He's a sponsor for the California MBA Legal Issues and Regulatory Conference. Just a reminder, December 11th and 12th down in Irvine, California. We will be there for the Legal Issues and Regulatory Compliance Conference. Don't forget to register. We do have sponsorship opportunities still available. Tracy, Michael, thank you so much. You dropped some serious title knowledge on everyone today. Samantha,
Thank you.
Melissa, anything y'all want to say?
Nailed it. Thank you so much, Tracy and Michael. We appreciate your time. And thanks everybody for joining. Melissa?
Thank you.
All right, bye.
Bye, everybody. Take care.
Bye.